Interest rates in Canada are dropping once again, and this isn't just another update. What does this mean for the housing market and your future? Today I'm breaking down how these interest rate cuts could directly impact you.
Ask Marco.
Hi, I'm Marco Momeni, and for over 22 years, I've helped people navigate the Toronto real estate market. If you're looking for an honest advice and expert insights, you are in the right place. Make sure to subscribe for weekly updates and ask Marco if you have any questions. If you're looking to sell or buy a property, you can book a call with me or my team in the first link in the description. So the Bank of Canada cut the interest rate, correct. But let's look at this from a different angle and see how this relates to inflation. I think it's important to consider whether we are repeating the same mistakes from our economic past. Let's set the scene. When central bank lowers interest rates, they aim to encourage spending and investment. The idea is that cheaper borrowing costs will help stimulate the economy, especially in uncertain times. However, history has shown us that this strategy can have unintended consequences. Let's look back to the early 2020. In response to a slowing economy, central banks around the world cut rates significantly. While this initially boosted growth, it also led to a housing bubble, and people borrowed more than they could afford. Fast forward to today, with the Bank of Canada cutting rates again, we need to ask ourselves, are we risking the same kind of bubble? Some experts argue that the rising debt levels and inflated asset prices, we might be setting ourselves up to another crisis. If borrowing becomes too easy, it could encourage reckless spending and lead to a surge in prices, making inflation a real threat. Canada's economy has been slowing down, and unemployment is currently at 6.5%. High interest rates have been a drag, but this cut aims to unleash consumer spending and boost investments. While you might not see the result overnight, expect a gradual uptick in economic activity. Now let's talk about inflation itself. When rates are low, it can lead to increased demand for goods and services. If supply doesn't keep up, prices can rise quickly. We saw this during the pandemic. When supply chains were disrupted and demand soared, inflation skyrocketed and forcing central banks to eventually raise rates again. What's next for the housing market? Will these cuts spark a revival? Experts from RBC and CoStar are cautiously optimistic but skeptical that this alone will be enough. The Bank of Canada may cut rates even further, possibly down to 3 to 3.25% by December. Let's watch how the market reacts in the coming months. But this is your chance to stay ahead of the game. So is the recent rate cuts a wise move, or are we making the same mistakes as before? On one hand, it can help to boost the economy and support the businesses and families. But on the other hand, we need to learn from history to ensure we're not repeating the same errors. Let's keep a close eye on how this plays out and advocate for balanced policies that protect our economy and financial well-being. If you want more updates like this and expert insights into the real estate market of Toronto and the GTA, make sure to subscribe. And if you have any questions about your next move, don't hesitate. Ask Marco. I will see you in the next video.